Welcome to the Michael Gates Mortgage Show. I am your host, Michael Gates, and today we're going to be talking about debt to income. Now, debt to income is basically exactly what it says. It's your debt versus your income. So, when you're talking about debt, you're talking about your car payments, your personal loans, your student loans, things like that. So, what has happened, or what are some of the things that has happened to people who've gone to buy a house, is they have gone to purchase a property, and they speak with the loan officer, and that loan officer says your credit is fine, you have enough money for your down payment, but we got to do something about your debt because your debt to income is a little bit too high. And that may be the first time you ever heard of debt to income. That may be a term that nobody's ever told you before. Now, you may have spoken with, or you may have applied for an apartment or gotten a lease somewhere, and they said you got to make 3 times the rent or things like that. It's kind of what they're talking about, but not exactly. Basically, when you're talking about debt to income, you may ask yourself, like, what actually is what actually is debt to income? So debt to income is basically your debt to income ratio is basically some people call it the DTI. It's your monthly debt payments divided by your gross income. Now, this number is one way lenders measure the ability to manage the monthly payments to repay the money that you plan to borrow. Basically, when a lender is evaluating your debt to income, they're just kind of evaluating your ability to pay back the debt. So when you're taking out a loan for a home, they're going to be looking at your credit report. So they're going to pull your credit, and they're going to look at your car payment, your student loans, your personal loans, credit cards, things like that. That may affect the amount of money that you have going out of the house. So when you're actually deciding to purchase a property, so when you're deciding to purchase a property, that's one of the things that you may want to consider. And you may say, well, what actually? So they told me different aspects of debt to income. They was talking about a front end ratio. They was talking about a back end ratio. They was talking about all these ratios. So can you kind of explain that to me, Mr. Michael Gates Mortgage Show guy? Of course. Basically, what your debt to income is your monthly debts divided by your gross monthly income, and that's how they calculate your debt to income. So they're going to take all your monthly payments, and they're going to divide it by your gross income, and that's going to be your debt to income. Now, they're going to say things like, what is my front end ratio and back end ratio, and what's the difference? Because when I sat down with that loan officer, they was talking about back end ratios and front end ratios. And so what's the difference between that? So basically, your front end ratio is your monthly mortgage payment divided by your monthly income. So you're going to take all of your monthly mortgage payments, and you're going to divide that by your monthly income, and you're going to get your front end ratio. Now, when you're talking about your back end ratio is basically going to be all of your debt divided by your monthly gross income. So when you are actually going to purchase a home, you want to calculate your debt, and you want to make sure that your debt is kind of low because you want that ratio to get low. So if your debt is low, then your debt to income ratio will be low. Now, before we get into how to calculate debt to income, let's take a brief moment for a small commercial break. we're back. I am the only home buy seminar that's going to have commercial breaks. Just keep that in mind. I got commercial breaks going on. Basically, I am going to promote my real estate agent partners. So when I'm having these home buy seminars and I'm talking about debt to income, I'm going to advise you these great real estate agents that I work with. I'm going to show you their commercials and what they're actually doing. All right, so back to our regularly scheduled program. So how do you actually calculate your DTI, your debt to income ratio? So your debt to income ratio is going to be your monthly payment. So for instance, if you have a monthly mortgage payment or a monthly rent payment, whatever the case may be, and it's $1,800, you have a monthly income of $5,000. So if you have a monthly mortgage payment of $1,800 and a monthly income of $5,000, your front end DTI is going to be 36%. Now, when you calculate your back end ratio, you're going to be calculating pretty much all your debt, right? You're going to do your rent, your mortgage, your car payment, any personal loans, credit cards, all of that. So say if your rental or your mortgage payment is $1,800 and you have a car payment that's $300. You got a personal loan out, $75. You got credit cards at about $125. So your total monthly debt is about $2,300. So now that we calculated your debt, we're going to divide that by your $5,000 monthly income, which is going to give you a back end DTI or a back end debt to income ratio of 46%. So when you're actually calculating your monthly income and your debt, your monthly debt, and you're dividing that by your income, that's going to give your DTI, and that's what's going to determine whether a loan or a lender is going to actually be able to qualify you for a loan. Certain FHA, VA, USDA, conventional loans, they're all going to have their thresholds. Not only that, lenders can do what they call overlays, and basically, without getting too far, too complicated, FHA can have their own set of rules, right? They can have rules where you got to put a certain amount down. You got to your credit score has to be a minimum of a certain amount, and your debt to income has to be a certain amount. Now, with that being said, a lender can take that FHA criteria or those FHA guidelines and kind of add to it. So if the FHA says, well, if you have a 580 credit score and your DTI is this amount, then we can qualify you. Now, the lender can come back and say yes, but in order for you to qualify, in order for us to do a loan with you, in order for us to do an FHA loan with you, then your credit score has to be a 620, or they may say your credit score has to be a 600. It's up to that lender's discretion, as long as they're not decreasing the guidelines. If they're increasing or they're adding to, a lender can do that. So that's something to keep in mind. So when you're talking about your debt to income ratio, FHA is going to be a little bit higher, but a specific lender may not go as high as FHA will allow. So that's just something to keep in mind when you're speaking with the loan officer or a lending agent or a lender or a bank, that you're basically keeping in mind that debt to income threshold. So you know how to calculate the debt to income now. So what are the actual thresholds? So FHA has a maximum threshold of 57%. Now, does that mean that every lender is going to go to 57% on their debt to income? Not necessarily. Some lenders may go a little bit less because they may feel that debt to income is a little bit too high and they don't want to take as much risk. For conventional loans, DTI is of about 50% can qualify you or less. Now, like I said before, that's just a guideline. On conventional loans, a lot of lenders are going to go below that 50% threshold. Now, USDA it's going to be a little bit less or lower down because there's no down payment for USDA loans. You just have to pay a funding fee. USDA will basically lend 100% of the loan, or guarantee 100% of the loan, is a better way to say that. But they do require a funding fee. So when they're doing 100% of the loan, their debt to income, in order to reduce their risk, they're going to have a lower debt to income threshold, because that debt to income threshold is going to lower their risk, so that they can lend 100% of the loan with less risk. So that's just a brief guideline, or brief give you a brief idea of what debt to income is talking about. And before we leave, let's just take one more quick commercial break.
The perfect match. It's what so many of us are looking for. When it comes to getting a mortgage, how can you find the one that's perfect for you? Start with your local independent mortgage broker, because the only way to get a mortgage that's cheaper, faster, and easier is to talk to us first. Find your perfect mortgage match. Call us today.
All right, guys, I do appreciate you guys joining in. I will be having the Michael Gates Mortgage Show on Tuesdays and Thursdays at 7 o'clock. If you have any mortgage or you have any lending questions, just get this. You can email me at mgates@happyhomelending.com. If you have any, if you can't email, or if you prefer to talk, you can always give me a call, 817-939, think about blah, blah, blah. Just give me an email. Now, just send me an email, mgates@happyhomelending.com. And you can give me a call, 817-939-6476. And then I'll be more than happy to answer any lending questions, any mortgage questions. If you're in the state of Texas, or if you're in the state of Louisiana and you're looking to buy a house or purchase a home, and you do need to get qualified or pre-qualified, or if you need to speak to a lender to go over some information, or just to let you know, or give you some, point you in the right directions for a realtor. I can give you realtor referrals. I can look at pre-approvals for you, but just let me know. And if you have any questions about debt to income that we went over today, just let me know. I will be more than happy to answer any questions. And that's it. Thank you for joining in. And you guys have a good evening.
Get stronger, fuller, thicker looking hair with up to 97% less breakage with Nexus Unbreakable Care. Fine hair bounces